Hi, welcome to Financial Education for the Nation. My name's Warren Shute. I'm bringing this to you in the new tax year. So, happy new tax year. How was your celebrations? Or did you have any? It doesn't really have the same ring to it, does it? But I've been bringing you recently lots of information about allowances and tax planning. And what I thought I would do today is change it up a little bit and talk to you about investing. What better time to take use or make use, of your tax allowances, your ISA allowance and your pension allowance than at the beginning of the tax year. You do it at the beginning of the tax year, you get a whole 12 months of extra benefit tax-free. And also you get to sit there nice and happy and smug when everyone else is rushing around at the last minute next year, trying to do it before the end of the tax year. So let's do it now, get sorted and get using your allowances. So two things you really need to consider when you're investing. So we know ISAs and pensions aren't investments, don't we? You know they're not investments, but no one's ever told you that. An ISA and a pension is a wrapper, a tax wrapper that sits around your investments. And then what you hold in that wrapper is your investment. So we can put £20,000 into an ISA, we can put maybe £10,000 to £40,000 plus your previous allowances into a pension. And that can sit in as cash, and then we invest it. So if you've got less than 5 years, maybe 5 to 7 years until you need to realize the money and get access to the money, whether it's pension or an ISA, you can't invest. You really do need to use cash. With investing, we really need at least 5 years, preferably 7 years of future growth to allow the investment to ride out any market volatility. So less than 5 years, really less than 7 years, stick it in cash, leave it in cash. Now, if you've got time on your side and you can hold it invested for at least 5 to 7 years, then we can invest. And when we invest, we've got two things that we need to consider. First thing is risk. Second thing is investment style, the management style of the investing. So let me touch on risk to start off with. Risk. I define risk in my firm, Lexington Wealth, as how much can your investment fall before you begin to feel uncomfortable. So we've got £100 invested. How much can it go down before you begin to feel uncomfortable and then start questioning the investment, the purpose, start worrying about it, maybe get a bit sleepless nights? Now, for some people, any fall will make them feel uncomfortable. And if that's you, if you're in that category, then don't invest, or really have a good talking to yourself to see how much risk you feel you could take with this money. Other people can take a lot of risk, and therefore they've got a lot of time on your side. So with time, generally speaking, you can accept more risk. So as you bring time in, you really should generally reduce the level of risk. So it depends what this money's earmarked for, but generally time and risk can be correlated. So a younger person can accept more risk. And a very old adage that we used to use as a rule of thumb, I wouldn't want you to go on this, but just to give you a bit of concept, is 100 minus your age. So if you're a 20-year-old, listen to this, 100 minus your age is 80. You generally can expect to have about 80% of your portfolio in equities in the stock market. Whereas if you're at the other end of the scale, say you are 70, 100 minus 70 gives you 30. You still want some money in the stock market, about 30%, but you wouldn't want all of it or a majority of it. And then when we talk about the stock market portion, the balancing portion generally is in short or medium-term fixed interest, not long-term, but short or medium-term fixed interest. And what that does, it dampens the volatility on the investment. So generally speaking, 100% stock market portfolio, you can expect to be volatile and have market drawdowns of about 50% in a period of time. So during the 2000 dot-com correction and during the 2007, 2008 financial crisis, we saw the stock markets as a whole correct about 47%, I think. And obviously, whatever market we look at around the world, it will vary slightly. As a general rule of thumb, again, it's good to have these parameters in your mind. 100% stock market generally can correct about 50%. So if that's too much for you, you then need to reduce your stock market exposure from 100% down. And we generally go down increments of 10 or 20%. So you bring it down to 90, 80, what have you. So if you had a 50% stock market portfolio, 50% fixed interest, the stock market portion might correct about 50%, so down to about 25% volatility on there. So that's risk, and we look at downside risk rather than volatility, because a low volatile fund can be trending downwards. Some advisors look at volatility, but volatility is how much the fund goes up and down. So it could be going up and down, up, which is fine, but it could be going up and down and going down. And really, clients look at their balance sheet or look at their valuation and think, oh my goodness, it's gone down. That's why we look at market drawdown. So just recap on risk. Look at drawdown, how much goes down. Generally speaking, 100% stock market has about a 50% drawdown on it. And as a rule of thumb, 100 minus your age is a starting point. How does that feel? And measure that up. You should be able to look at some historical information on the funds, and you really want more than 10 years really of data. The longer, the better. If you get yourself over to lexo.co.uk, I've got 10 portfolios on there from no stock market exposure up to 100% stock market exposure. And you can see the maximum drawdowns at each of the portfolios and the returns, give you some kind of flavor of what we offer our clients here at Lexo and Lexington Wealth. So the second thing you need to consider is investment style, investment management style. And there are two investment management styles that you can choose from. The most common, it would be fair to say, is active management. But the most modern, most progressive is passive or indexed management. Let me just briefly explain the two so you're aware of what's going on. The active management style is where you as a fund holder, an investor, pays a higher fee generally to pay a man or a woman, a fund manager, to buy and sell shares or bonds on your behalf to try and outperform their index, their benchmark. And generally their benchmark is a benchmark they've put together to say that, okay, if we outperform this, we're doing well. The cost of an active fund is a lot higher than an index or a passive fund. And there's lots of news articles and research around saying, well, are you really getting value for money? I'll come on to that in a second. The second investment style is index or passive funds. They're the same thing, an index tracking fund or a passive fund. And an index tracking fund or a passive fund is basically where you buy a selection of shares, investments, and they track the underlying index in which they are mirroring. And generally speaking, there's not an individual involved. It's run by a computer. And if something falls out, they'll buy. If something falls out of the index, they'll then buy what gets replaced. They'll sell that, and you mirror this. Now, there is a lot of argument to say that index investing is a lot better, primarily because you're not trying to time the market, which research has proven is pretty much fruitless. You can't do it. And also the charges, the fees are a lot lower. So the investor's keeping a lot more of the money. We at Lexington and Lexo have almost like a bit of a hybrid. We take the best bits of active management, which basically is a filter, and we buy passive or index funds with it. So in other words, what we do is we're buying an index, but we're filtering out unprofitable companies and highly regulated companies. We just buy the other companies that are there, and then we just sit tight and hold on to them. And we do that, and we keep our fees as low as possible. So if you're looking at an index option, not all index funds are the same, by the way. Virgin index fund is quite highly charged relative to the other index funds on the market. I think there's a merger going on at the moment between Virgin Fund Management and Standard Life. And it's ironic because I think Standard Life's index fund is very, very inexpensive. So there's a merger going on, but there's a lot of disparity between the fund charges. So you want to keep the fund charges very low. On Lexo, you can go online. There's a calculator there. You can see what the fund charges are and things. It's a very low charge portfolio arrangement. You do the data entry and the work, and we outsource the investment management to dimensional fund advisors typically. So they're the two sort of different styles. There's a lot of argument about which side is best. Some of the biggest financial advising product sales companies in the UK are active in their approach. However, all of the academic research that I'm aware of, at least, that's come out of the universities is really saying we can't see how consistently active fund managers are outperforming the market. They just generally don't do it. Warren Buffett, one of the world's greatest investors, has come out and said when he dies, he's leaving his estate to an S&P 500 index fund, basically. So he's not even leaving his money into an active arrangement. And 10 years ago now, he placed a bet with the community of £1 million, I believe. There's a video on this on the site where he said, anyone wants to try and beat the S&P 500 over the next 10 years, I'll put up £1 million and you can win it. And only one person out of every single active fund manager out there in the world came forward. Only one person came forward. And he bought a collection of hedge funds, which supposedly make money when the market goes up and the market goes down. And the S&P 500 annihilated it, completely smashed it out of the water. So when Warren Buffett said, look, put your money where your mouth is, I'll put up £1 million bet. Anyone wants to try and beat the S&P 500, so don't beat him, beat the S&P 500 index, which you as an individual just buy. No one took him up on the bet apart from one person. And that one person bought a basket, so a group of hedge funds, which are always kept private because obviously they don't want to lose their credibility. And 9 years after the bet started, it was a 10-year bet, 9 years after the bet started, they closed the bet early because there was no way that the hedge funds could make up the lost ground. They were so underperforming. And if you look on the site, you type in Warren Buffett, there's some data on there, there's an article on there about how the performance was, if you're interested. Now, hedge fund managers would, not hedge fund managers, active fund managers would say, well, look at these statistics, look how well we have done against the index. So although that Warren sits there and does these videos every week, actually, based on this information, we are outperforming. So you might have a financial advisor comes to see you, might come to your home and show you the statistics, say, look how well they're doing. One of the things that they generally omit to bring to your attention is a thing called survivorship bias. And survivorship bias is basically that let's say, for example, the 100 companies that started 10 years ago with their fund performance, when you look at them now, you might be looking at 100 companies, but you're not looking at the same 100 companies. And the reason being is a lot of those companies have gone out of business. And when they've gone out of business, they've either merged or remerged something, new ones have started up. Let me try and give you this sort of story or analogy as an example. During World War II, when the planes were coming back and they could see all the shot bullet holes in the planes, a group of engineers were asked, where should we put the supportive metal as reinforcements, especially for the protective guards, the metal to protect the planes to save them being shot down? And, well, ask yourself a question. So the plane's coming back, there's lots of bullet holes in the planes, and they land, they overlook the planes, and let's say 100 planes left the battlefield, and let's say 50 planes came back, and they look at those planes that come back, and they look at the bullet holes, and where do they put the protective plates to protect the planes from crashing or being shot down? To have a little thing. The group who were there said, well, look, we should put them here, here, and here, and they showed on the plane because this is where most of the shot marks are, and that would therefore protect the planes. Well, if you think about it, it's not those planes they need to protect. Those planes got back, and those planes are safe. What we really do is we need to look at where the shots and the bullet marks were on the planes that were shot down, because if we put the protective plates where those shots were, maybe those planes would have survived. And that's where survivorship bias came from. How can we try to protect more of what we've got? And looking at our investments is in the same way. When we look at the funds that we've got today, how many of those funds were actually around 10 years ago? Because how would you have known 10 years ago to invest in those ones? Because they didn't have that 10-year track record. All we have to go on is that they are funds now. We don't know where they were relative to everything else 10 years ago. So active fund management, apart from being expensive, is fraught with funds being wound up, merged by the fund management companies so that they look better. And in addition to that, quite often they are more concentrated in their portfolio size. They may only have 200-300 equities in their fund, whereas the Lexo portfolios have about 10,000 individual equities in their fund. And when you're investing, diversification is one of your friends. because we don't know if we're going to have another Carillion, for example, or another company that's going to potentially go out of business, another WorldCom or something go bust. We want to have companies over a broader area. We need to spread it out. So diversification is your friend. So having more than 200 or 300 companies is better for you than having just a more concentrated portfolio. So this isn't a video on why active, why passive. It's a video on making use of your ISA and your pension allowance early on. So I started saying there's two considerations for you to have. One was how much risk. And remember we said about risk, time is your friend. The more time you've got, the more risk or the more stock market exposure you can take. And when looking at risk, we generally look at how much it's gone down in value over time. So you can then correlate that to what it might be like going forward. It's not guaranteed what it might be like. And also making sure that you understand that if you're in your 70s, maybe 30% stock market, 100 minus your age is roughly a good template to start with. But if you're in your 20s, maybe 80% or so is a good place to start. Okay. Then we went on to management styles, and I kind of compared active management and passive management. Active management, when you pay an individual buy and sell the shares for you, pay a lot higher charges, and there's a lot of skullduggery maybe going on in there with regards to the statistics and how everything's performed. Whereas the other end of the spectrum is index investing, and you can buy index funds or tracker funds or passive funds, all the same thing. And then you basically buy the market. So in the UK, you might buy the FTSE All Share. World markets, you might buy the MSCI World Market. That's a better index to buy because you get an exposure to global equities as well. So come to the start of the tax year. Let's take advantage of the 12 months you've got ahead of you. Use your ISA allowance, use your pension allowance now. Consider the level of risk you want to take. Don't take on more risk. Investing for the long term, the idea is you choose a portfolio and you stick with it. You don't start chopping and changing when markets go up, markets go down. You just ride them out and allow it to perform for you over time. That will give you a better investment experience than trying to time the top or the bottom of the market, because you won't do it. People get paid millions of pounds in the city. They can't do it. It's proven by the Warren Buffett example, time the market. So I'm sorry, you're not going to be able to do it either. So let's just buy the market, sit tight, make sure you only take on as much stock market risk as you feel comfortable. Remember, about 50% downside on a 100% portfolio. So that'd be half of it on a 50% portfolio. You kind of work out the figures. If you're a bit confused or stuck on that, go to lexo.co.uk. There's the 10 portfolios on there. You can see what the downside risks are, see what the average analyzed returns are as well. And I would encourage you, if you don't have a preference to either, to look down the index route. All the Lexo portfolios, if you go there, they are index passive portfolios. So it'll give you a smoother ride or a more certain ride over time. Doesn't mean they don't go down. They do go down in value, but they do go up over time as well. So hopefully that's been useful. So hopefully that video today summarizing the investment experience and what to do will be helpful for you. If you've got any questions or things you'd like me to cover in the future, I've got in the bag of tricks things about wills and power of attorneys and estate planning, inheritance tax. We're just doing something at the moment around an individual buying a property into a trust and the benefits behind that and why they're doing it to protect the money, so it makes sure that the property can go to who they intend to on their death. I'll make sure I cover that in a future video. But please contact me, send me a Facebook message, send me an email, warren@warrenshute.com, whatever's easiest for you. Connect me on Facebook, LinkedIn, Twitter, all the other social media sites. I do appreciate you watching, and it is fun and easier for me when you ask me questions. I can just respond to them, and I'm very happy to take questions. Anything regards finance, financial planning, that kind of thing, any question you might have, it's always interesting. So thank you once again for listening. My name is Warren Shute. This has been Financial Education for the Nation, and I look forward to speaking to you again.